Hello, Steve Lentz here with Discover Options here at Option View Systems International. Welcome to this presentation of three different S&P 500 market timing reports for advanced options traders. This will be for Friday, September 21st, getting ready for Monday, the open on the 24th. Presented material is for educational purposes only, should not be construed as personalized financial advice. Past results are not necessarily indicative of future performance. Before we get going, you should know that Discover Options is the educational arm of Option View Systems International. We focus primarily on the one-on-one mentoring experience. If you're a beginner to an intermediate level options trader and you want to quickly get to an advanced level in as fast a form as possible, give us a call. Go to our website, check out discoveroptions.com. We have a fantastic set of courses. All of our courses involve a one-on-one session with one of our professional trading mentors, and they will help you understand the material and get up to speed quickly, whether you trade directionally or you want to trade non-directionally in the indexes, stocks, even futures. Okay, and so that said, let's get going. All of our reports are in the context of the current market condition. And we describe our current market condition in the context of three different dimensions: price action, trend, and the stochastic situation. In terms of price action, Friday was an upswing day with a higher high, higher low. Thursday was an upswing day with a higher high, higher low. So we had two consecutive upswings, but Friday's day was one where the close was lower than the open. Kind of interesting. Even though it was an upswing day, the close was lower than the open. And so that price action is kind of unique. It took place in the context of an uptrend. The closes were above our 50-day simple moving average. And in terms of the stochastic, we're between 50 and really, and it should say 100 there. I'm going to just change that because I know that's true. 50 and 100, okay? And the stochastic is above the 3-day %D that you can see down there. This entire market condition, defined by these three dimensions, has occurred roughly 127 times since January of 2000. So a pretty good sample, okay? A real good sample there. So with that said, this market condition is in mind. Let's now go to our first report, which is for those that like to trade condors and butterflies. The question here is now a good time to implement a condor or butterfly campaign? So here's the report. As I've mentioned, since January of 2000, we've had roughly 4,719 total daily closes of the S&P 500. Of those, 65% have been favorable bars for selling options premium, where the actual 21-bar subsequent movement turned out to be less than what the SIBO's skew-adjusted VIX was implying. Okay, so once again, we're talking about selling options premium. The actual market has been less volatile than what the VIX, the skew-adjusted VIX, was implying. That's occurred roughly 2/3 of the time. So that's our benchmark at 65%. Now, our current market condition, as I mentioned, has occurred 127 times. Of those 127 occurrences, 66.9% of the bars have been similarly favorable, like what I described for option premium selling. That's about a 1.9% edge. Pretty much it's a wash. It's pretty flat, very, very similar, slight tiny edge of 1.9%, looking at those 127. Occurrences. Okay, so statistically, it's slightly more likely than normal that our current market condition will end up being a favorable one for selling options premium through these neutral strategies like condors or butterflies. Okay, so it's pretty much a wash. Let's now go to the bull put spread report. This is the same way. This presupposes that we're going to sell options premium in a bullish fashion by selling puts, a standard deviation out about 30 days away, about a standard deviation away about 30 days out in time. Okay, so as I mentioned, we've had 4,719 daily closes of the S&Ps. Of those 4,719, 83.2% turned out to have been favorable bars for selling puts, like I just told you, 30 days out in time, a standard deviation out of the money, where the actual 21 bar downside movement, 83.2% of the time, the actual downside movement was less than what was being implied by this SIBO's skew-adjusted VIX implied movement to the downside. Okay, so you can flip a coin continually, 83.2% of the time, you'll end up on a bar that turns out to be favorable for selling puts in this fashion. Now, of the 127 times that our current market condition has occurred, 83.4% of the time, the bars were similarly favorable. That's a slight edge of 0.2%. Pretty much a wash. Okay, so that's it for the bull put spread report. Now, let's go and take a look. This is a bit more interesting. Well, it's all kind of interesting, right? But let's go and take a look at the market likelihood report. And I did not get this. Just 1 second here. Okay, corrected that. This is the market likelihood report, whereby we look at the average rate of change in 3 different time frames. We also look at volatility as well and make some evaluations here. So let's just go through this. Let me get my little marker here. And here we're looking at 4,723 closes of the S&P 500. And then we look at the average 5-day rate of change, the 10-day or 2-week rate of change, and the 15-day or 3-week rate of change. What does this mean? This means that we take a close and we look forward 5 days or 5 bars, and we just check out to see how much the market moved from one close to the close 5 bars forward. Okay, so a 1-week change. Now, altogether, over the course of 4,723 closes of the S&P 500, the average 1-week rate of change was 0.11%, basically just a little over a tenth of a percent. Okay, now keep in mind, since Jan of 2000, the market's been going up. On average, you have a 1-week rate of change of a tenth of a percent, a 2-week rate of change of roughly a fifth of a percent or 0.2, then a 3-week rate of change of about 0.3, not quite, just a little bit underneath, a third of a percent every 3 weeks. Okay? Now, that's the benchmark rate of change. Now let's take a look at the 128 occurrences of our current market condition. That's roughly 2.7% of the total. On average, the 5-day rate of change is 0.06% to the downside. Okay, the 2-week rate of change is about about 0.15% to the downside, and then the 3-week rate of change is about about 0.01%, like 1% of 1% to the downside. Pretty flat. Honestly, quite flat. How significant is this 0.06? Instead of going up a tenth of a percent, it goes down a 6%, 0.06% to the downside in the other direction. How significant is that difference? Well, what we do is we take the difference divided by the standard deviation to give us what we call a z-score. And what that z-score in this case represents is about a 0.2 or 0.21, or about a fifth of a standard deviation to the downside. That's what this is. This is leaning about a fifth of a standard deviation to the downside. The 2-week rate of change difference is about a third of a standard deviation to the downside, and the 3-week is again about a fifth of a standard deviation to the downside. Not even half a standard deviation to the downside. Now, all 3 time frames are leaning bearish, okay, but not by very much. Not by enough to get super bearish about. But just keep that in mind. In the course of history, it's definitely averaging to the downside. Okay, definitely leaning bearish, but not by a huge amount, but consistent in all three time frames nonetheless. Now we can carve this up into those times where Friday's high was exceeded on Monday and those times where Friday's low was exceeded on Monday. And so in terms of going up above Friday's high, that occurred 61 times in the past on our market condition. Here the z-scores are at 0.09%, not even a tenth of a standard deviation to the upside, about a quarter of a standard deviation to the downside, and about a tenth of a standard deviation to the downside. Nothing huge to write home about. Now, if the market goes down below Friday's low, now we have z-scores more significant, about a half a standard deviation to the downside in a 1 week period, 0.43 and 0.3 of a standard deviation to the downside. Okay, so again, leaning definitely bearish. If you had to pick a direction, you would lean it definitely bearish. Now, in terms of volatility, look at this. On average, the market averages roughly 15.5 to 16% on an annualized basis for a 30-day, or for, in this case, both 5, 10, and 15-day realized volatility levels. Annualized, roughly 15.5 to 16% annualized. Now, our current market condition results in annualized volatility levels in all three time frames roughly between 11 and 12.5%. Okay, quite a bit less than what the benchmark is. Now we can carve that up in terms of times when the market goes above Friday's high or below Friday's low, and you can see here, again, a bit less of a realized volatility on the upside, and it grows a little bit, of course, if it goes to the downside. Mind you, the VIX is at just a little over 11.5, okay, which is kind of right in the ballpark of our average volatility, realized volatility level there, and don't see a huge edge sticking out in this case. Everything's kind of flat relative to the benchmark readings. And so, but directionally, I think you have to lean just a squeege bearish if you had to make a prediction here. Just looking at the history as to how this plays out is obvious on the likelihood report here. Okay, finally, let's see, let's go here. Let's get rid of this. All right. Okay. Just want to wrap this up. Thanks for joining us again. Check out our website at discoveroptions.com. Give us a call if you want to piece together a curriculum to get you to the place where you want to be in your options trading career. I'm Steve Lentz with Discover Options. Thank you.